Hello guys, my name is Simo from Investment Research. I am a junior equity research analyst, so before I give you my analysis of today, I wanted to clarify that I started this channel with the purpose to give everyone the right to be a successful investor. I am currently working a full-time job, so for now I can't appear on the screen just to avoid any issues on my current job, so I try my best to provide you with some value-added content when it comes to investments. Also, I wanted to say thanks to people who were supportive to my small channel because I noticed some of you are new here, so I just want to clarify this point. Alright, so today is Tuesday, January 20. Let me tell you right up front, if you've been following my analysis, you know I don't chase headlines or panic with the retail crowd. I look at what institutional investors are actually doing, what the SEC filings really say, what the fundamentals tell us, and where the smart money is positioning. And what I'm seeing right now tells me this dip is more opportunity than risk, but let me walk you through the proof step by step so you can make your own informed decision. First, let's get the price action crystal clear because context matters tremendously here. We closed Friday, January 17th at 26.13, down 1.17% from Thursday. Markets were closed yesterday for Martin Luther King Jr. Day, so this morning, Tuesday, January 20th, we opened at 25.77, which puts us down another 1.38% from Friday's close. We're now trading roughly 20.3% below the 32.73 peak we hit in November and early December. But here's what most people are missing. We're still up 90.5% for 2025. This stock ran from 860 in April 2025 to 32.73 by November. That's a 280% move in 7 months. A 20% pullback after a 280% run is not a collapse, it's a healthy consolidation. When I see this kind of move, the first thing I do is check volume because volume tells you whether this is real institutional selling pressure or just technical noise and profit taking. Yesterday being a holiday, there was no trading, but Friday's volume was 40.8 million shares versus the 3-month average of 63 million. That's actually below average, which tells me this is not panic selling. If institutions were dumping or retail was capitulating, you'd see 100 million plus shares traded. What I'm seeing instead is market makers adjusting inventory, some profit taking after the massive 2025 run, and technical traders playing the $26 support level. That's not the same thing as fundamental deterioration, and here's exactly why I know that. No, the immediate trigger everyone is talking about, the reason the media is screaming about today's decline, is the underwriters fully exercising their green shoe option on the December equity offering. Instead of the original 54.5 million shares at 27.50, they exercised the full 15% option and bought an additional 3.25 million shares, bringing the total to 57.75 million shares issued. That's approximately $1.59 billion in total capital raised and about 4.8% dilution to existing shareholders. Now, I completely get it. Dilution is never fun. Your ownership slice of the pie gets slightly smaller. But let me explain why this is actually a bullish signal that 99% of retail investors completely miss. Underwriters only exercise the full 15% green shoe option when they see strong institutional demand for shares. Think about it logically. If the December offering had been weak, if institutions thought this company was overvalued or facing problems, the underwriters would have exercised zero or a minimal amount of that option. The fact that they took the full $89 million additional allocation tells me smart money still wanted exposure even at $27.50 per share. That's proof positive of demand, not lack of demand. The underwriters wouldn't be buying millions more shares to distribute to institutional clients if those clients weren't asking for allocation. This is textbook bullish institutional activity disguised as bearish news. But here's where it gets really interesting, and this is the data that convinced me personally that institutions are accumulating aggressively, not distributing. I spent my entire weekend going through SEC 13F filings and institutional ownership reports that dropped over the past week. Let me give you the numbers because data doesn't lie, people do. D.A. Davidson just increased their position by 30.6%, adding 37,415 shares to bring their total to 159,543 shares worth $4.2 million. Steinberg Anna Wealth Management made a fresh $2.19 million investment. KLP Capital Forvaltning, a major Norwegian asset manager, raised their stake. Norges Bank, Norway's sovereign wealth fund, holds $164 million. Marshall Wace owns nearly $146 million after boosting their position by 88%. ARK Investment Management has $80 million after a 118% increase. Now some of you might say, wait, didn't Cathie Wood's ARK sell shares recently? Yes, they did trim on December 12th, but they still hold $80 million worth after increasing 118% overall. And frankly, I don't care what Cathie Wood is doing, ARK's performance over the past 3 years has been terrible. What I care about is what JP Morgan, BlackRock, Vanguard and Norges Bank are doing. These are institutions managing trillions of dollars, not a $10 billion ETF that's down 70% from its peak. JP Morgan Chase added 42 million shares in Q3, increasing their position by 881%. BlackRock added 13.5 million shares, up 27.8%. Vanguard added 6.8 million shares. Rakuten Securities increased their stake by 137% to 866,496 shares, making this their third largest position at 8.4% of their entire portfolio. That's hundreds of millions in fresh institutional capital flowing in at these exact price levels while retail panics about dilution headlines. Institutions don't do that unless they believe in the fundamental story and they see value. When JP Morgan, which underwrote the $1.5 billion offering and has direct access to management and private financial data, increases their position by 881%, that tells me everything I need to know. They're not buying to flip it for a quick trade. They're building a long-term position because they believe this company is going to be worth multiples of the current price within 18 to 24 months. Now let me prove to you why the fundamentals justify that institutional confidence, because numbers don't lie. Q3 revenue was $949.6 million, up 37.7% year over year. That's not slowing growth, that's accelerating growth. Adjusted EPS beat estimates at 0.11 versus 0.09 expected. The company added 905,000 new members in Q3 alone, representing 35% year-over-year growth, bringing total members to 12.6 million. They're cross-selling 1.4 million new products per quarter, which drives lifetime value significantly higher. The cross-buy rate reached 40%, meaning 40% of members are using multiple products on the platform. That creates ecosystem lock-in and switching costs that competitors cannot easily replicate. Credit quality, which is what everyone obsesses about in the lending sector, remains outstanding. Personal loan charge-offs were 2.6% in Q3, down 20 basis points quarter over quarter. Average FICO score is 745 on personal loans and 773 on student loans. Average borrower income is $157,000. While industry credit card delinquencies hit 11%, the highest since the Great Recession in 2008, this company's borrowers are holding up perfectly because they're prime quality, not subprime risk. They're lending to the top 30% of consumers by income and credit score, and that cohort is not struggling. They're the ones the Federal Reserve says are still spending on travel, luxury goods, and experiences. Let me address the valuation debate head on, because this is what gets everyone emotional and causes people to make bad decisions. Yes, the PE ratio is 49 to 54 times trailing earnings, depending on which data source you use. Is that expensive? Absolutely. The financial services industry average is 9.5 times. But here's what you need to understand. Growth stocks trade at premiums when they're delivering growth, and this company is delivering 38% revenue growth while being profitable for 8 consecutive quarters. That combination is extremely rare in fintech. Simply Wall Street says the fair PE is 24.8 times, implying significant overvaluation. But their model doesn't fully credit the ecosystem value, the sticky customers, the network effects, the new revenue streams from crypto trading, stablecoin issuance, SoFi smart card interchange fees, THTA ETF management fees, and international payment capabilities through blockchain. They're modeling this as a traditional lender when it's actually becoming a financial services platform with multiple high margin revenue streams. The analyst dispersion proves my point about uncertainty, not necessarily bearishness. There are 23 analysts covering this stock. 6 have buy ratings with an average price target above $32. 13 have hold ratings with targets ranging from $25 to $28. 3 have sell ratings around $20. The consensus target is 25 or 50. Needham has a 36 target. Bank of America has a 20 or 50 target. 24/7 Wall Street has a 35.70 year-end target. That wide spread from $12 to $38 tells me Wall Street doesn't know how to value this company because it doesn't fit neatly into traditional financial services valuation frameworks. Some analysts see it as a bank and use bank multiples. Others see it as a fintech platform and use growth multiples. The truth is somewhere in between. Here's my framework for thinking about this, and I want you to really understand this because it's critical for making the right decision at these levels. If earnings on January 30th, which is 10 days from today, deliver 30% plus member growth, 15% plus adoption on crypto and the smart card, stable credit metrics with charge-offs staying below 3%, and raised Q1 2026 guidance showing continued momentum, then $30 to $32 is absolutely realistic. That's 14% to 24% upside from current levels. Institutions buying at $26 to $27 clearly expect this outcome. On the flip side, if growth slows to 25%, credit quality deteriorates with charge-offs ticking up toward 3.5% to 4%, and guidance is cautious, then we test the $24 to $25 support levels. That's 7% to 10% downside from current levels. But even in that scenario, $24 to $25 represents 2025 price levels after a 90% annual return. That would be a buying opportunity, not a reason to panic sell.
The options market is telling us exactly what smart money expects. Call option volume is 65.5% versus put volume at 34.5%. That's a 3.2 to 1 call to put ratio, which is heavily bullish. I'm seeing bull call spreads being built for February expiration at the $27-$28 strikes, calendar spreads targeting $32 around earnings, and very little protective put buying. This is not institutions hedging for disaster. This is institutions positioning for upside. Now let me talk about the lending sector backdrop because this context is absolutely critical for understanding why institutions are buying at these levels. On January 12th, President Trump proposed capping credit card interest rates at 10%. The market initially freaked out. Capital One dropped 7% because their business model is heavily credit card focused. But here's what most people completely missed, and this is why I think Trump's proposal is actually massively bullish for this company, not bearish. If banks are forced to cap rates at 10%, they cannot lend profitably to subprime or near prime borrowers. The math doesn't work. Banks told CNBC on January 12th, quote, "We cannot offer products at a loss. There's no scenario where we would take our entire portfolio to 10%. They said explicitly that the industry would stop offering access to customers with subprime credit and scale back rewards programs. Consumers would either spend less or rely on other forms of unsecured debt." The key phrase there is other forms of unsecured debt. That means personal loans from fintech platforms. This company offers personal loans at rates that are already competitive with what banks charge to prime borrowers, typically 12% to 15% APR for someone with a 745 FICO score. If banks exit the subprime credit card market entirely because they can't make money at 10% interest rates with 8% to 11% default rates, the addressable market for personal loans to prime borrowers explodes. Millions of consumers with 650 to 700 FICO scores who currently have credit cards at 22% to 25% APR are going to lose access to bank credit. Where do they go? They consolidate their balances into personal loans from alternative lenders. That's a massive tailwind for this company in 2026 and 2027. The Federal Reserve released their latest data on consumer credit on January 16th. Revolving credit, which is credit cards, decreased at an annual rate of 1.9% in November. Non-revolving credit, which includes personal loans and auto loans, increased at 2.0%. What does that tell you? Traditional banks are already pulling back from credit card lending, while personal loan demand is growing. This company is positioned perfectly in the middle of that trend. They're not a credit card company exposed to the 10% cap risk. They're a personal loan platform benefiting from banks tightening credit card underwriting. Carlyle Group released their 2026 credit outlook on January 15th, and they said banks are pulling back from lending due to regulatory pressure and capital constraints. Private lenders are stepping into more complex situations that require bespoke capital solutions. This shift is structural, not cyclical. Companies and consumers are turning to private credit because banks can't or won't lend. That's the macro backdrop, and it's incredibly favorable for alternative lending platforms with technology, data, and a national bank charter.
Now, the big question everyone is asking me, Simo, is this the perfect time to buy more? Let me give you my honest professional opinion based on 15 years of analyzing financial services companies. At 25.77, which is where we opened this morning, you're buying at a 21.3% discount from the 32.73 peak. You're buying at levels where JP Morgan added aggressively in Q3. You're buying 10 days before a major earnings catalyst on January 30th that I believe will be a beat and raise. And you're buying into a lending sector trend where banks are tightening and alternative lenders are gaining share. If you don't own any shares yet, I would start building a position at these levels. Don't go all in at one price. Use a scaling approach. Buy 25% of your intended position at $25.75 to $26. If it drops to $25 to $25.50, add another 25%. If it drops to $24 to $24.50, add another 25%. Keep the final 25% in reserve for opportunistic buying if we get a flush to $23 or below, which I don't expect, but you should always be prepared for. If you already own shares from lower prices, say you bought at $15 to $20, you're up 30% to 72%. Don't sell here. This is not the top. The top comes when member growth slows below 20%, when credit quality deteriorates materially, when management guides down, or when the PE ratio expands to 80 to 100 times earnings with decelerating growth. None of those things are happening. Hold your core position and consider adding at $26 or below to lower your average cost and increase your position size. If you bought in the high 20s and you're underwater, you have two choices. Option 1, average down at $26 or below to lower your cost basis. If you bought at $29 and you add at $25, your new average is $27. If the stock goes to $32 after earnings, you're up 18.5% instead of up 10.3%. Option 2, hold and wait for the post-earnings rally. Don't panic sell at $26 after buying at $29. That's the worst possible decision. You're locking in a loss right before a catalyst that could take you back to break even or better. Let me talk about option strategies because this is where you can enhance returns or generate income while the stock consolidates. Implied volatility is elevated at 68% to 70%, which means option premiums are fat. If you own 100 shares at any price, sell the January 31st $28 call expiring right after earnings and collect approximately $1 to $1.30 in premium. That's $100 to $130 in immediate income, representing 3.8% to 5.0% return in 11 days. If the stock stays below 28, you keep your shares and the premium. If it goes above $28, your shares get called away at $28, but you still make the premium plus the capital gain from $25.27 to 28 euros, which is 8.7% plus the premium. Either scenario is a win. If you don't own shares but you want to buy at a lower price, Sell the January 31st $25 cash secured put and collect approximately $0.90 to $1.20 in premium. That's $90 to $120 for committing $2,500 in cash for 11 days, which is a 3.6% to 4.8% return. If the stock stays above 20 files, you keep the premium and you can sell puts again the following week. If it drops below $25, you buy shares at $25, but your effective cost basis is $23.80 to $24.10 after the premium. That's an outstanding entry point 10 days before earnings. If you're bullish and you want leveraged exposure, buy the February 7th $27 call for approximately 1.60 to 2.0 reals. If the stock rallies to $30 after earnings on January 30th, your call could be worth 3.0 reals to $4 reals, which is 100% to 150% return on your premium. But understand the risk. If the stock stays below $27, you lose 100% of your premium. Only use this strategy with money you can afford to lose and size it appropriately as 2% to 5% of your total position, not 50%. The key levels I'm watching this week are absolutely critical. On the upside, 26.75 is first resistance. We tested that level Friday and got rejected. If we break and hold above 26.75 on volume, the next target is 27.50, which was the offering price. Above 27.50, we're looking at $28.50 to $29, and then $30 becomes realistic ahead of earnings. On the downside, $26 is critical support. We tested $25.98 on Friday and bounced immediately. If we break $26 and close below it on heavy volume, the next support is $25.50, then $25. Below $25, we could see $24.50, but I'd be shocked if institutions let it fall that far with earnings just 10 days away. My conviction rating for this week is 8 out of 10. I'm bullish, the setup is favorable. Institutions are supporting the stock at $26. Earnings are 10 days away on January 30th. The lending sector is shifting in favor of alternative lenders as banks tighten. The product roadmap is strong with crypto, the smart card, THTA ETF, and international payments all ramping in 2026. And the valuation, while elevated, is justified by 38% revenue growth and diversification into higher margin businesses. My price target for end of this week is $27 to $27.50, which is up 4.8% to 6.7% from this morning's open at $25.77. I'm not expecting fireworks this week. We're in consolidation mode heading into earnings, but I also don't expect a breakdown below $25 unless something catastrophic happens in the broader market. My target for after earnings on January 30th is $30 to $32, assuming they beat revenue estimates of $981 million, guide Q1 and full year 2026 above consensus, show member growth staying above 30%, and maintain strong credit quality metrics. Let me close with this because I want to make sure you really understand the opportunity in front of you right now. We're 10 days from a major catalyst. Institutions own 56.69% of shares and they're buying, not selling. The Federal Reserve's data shows banks are tightening credit card lending while personal loan demand is growing. Trump's 10% credit card cap proposal, if it passes, will force banks to exit subprime lending entirely, creating a massive opportunity for alternative lenders. The stock has pulled back 20% from the peak and is consolidating at levels where JP Morgan built an 1881% larger position. This is not the time to panic. This is the time to be strategic, disciplined, and positioned for the move that's coming after earnings. The smart money is buying. The fundamentals are strong. The sector trends are favorable. And the risk reward at $25.77 is compelling. If you've been waiting for a pullback to add exposure or start a position, this is that pullback. If you already own it, hold and consider adding. If you're underwater, average down or hold for the recovery. Don't make emotional decisions based on 1 or 2 days of price action. Follow the institutions, follow the data, follow the fundamentals, and position yourself for what I believe will be a significant re-rating once Q4 results confirm the growth story is intact and accelerating into 2026. Stay disciplined, protect your capital with proper position sizing and risk management, and remember that the best opportunities often look scary in the moment. This is one of those moments. Thanks for your time today. I'll be back tomorrow with another update as we get closer to earnings. Trade smart, stay focused on the long-term opportunity, and don't let short-term volatility shake you out of a winning position.